Hello friends, welcome to the October edition of Monthly Viewpoints. The month of September saw a perfect storm for the equity markets. We saw increased volatility on the back of global macro factors such as rising oil prices, a strong US dollar and the trade war, as well as domestic developments including default by a large financial institution which led to liquidity tightening. Now, over the past 4 months, we have been reiterating that it is important to have crude prices in the $55 to $65 per barrel range for a stable macroeconomic environment in India. However, Brent crude prices rallied more than 6% in September due to lower supply and reached a 4-year high of $86 per barrel. We believe that oil prices are poised to remain at elevated levels over the next few quarters due to lower supply from OPEC and lower than projected growth in the US shale oil production. In order to provide some relief to consumers from rising fuel prices, the government has resorted to excise duty cuts and price intervention. While this is a populist move, the government has reiterated that it will maintain its fiscal deficit target of 3.3% of GDP. However, we believe that there is a risk of fiscal slippage by 0.2 to 0.3 percentage points due to lower GST collections, higher MSP for farmers, and lower divestments. Coming to the currency markets, the US dollar strengthened further in September as the Fed raised its benchmark rate by 25 basis points on the back of strong US economic data. Year to date, the rupee has depreciated almost 14% and crossed levels of 74 rupees to a dollar. In comparison, currencies of other emerging markets such as Brazil, South Africa and Russia have also depreciated between 14 and 17% year to date versus the dollar, while the Chinese currency has depreciated more than 5%. A point to note is that amidst all the global volatility, India is relatively better placed as compared to other emerging markets as we are a high-growth economy driven by domestic demand, we have sufficient forex reserves of $400 billion and inflation is benign. Hence, even as other emerging countries elected to increase their interest rates to defend their currency, the RBI at its meeting last Friday maintained its policy rate citing low inflation expectations. However, this ended up spooking the currency markets. Reiterating our view which we had provided last month, we believe that the rupee will continue to have a depreciating bias and hence recommend that investors recalibrate their portfolios accordingly. Now coming to the domestic markets, we saw disruption due to IL&FS, a large financial institution, defaulting on its short-term obligations. This led to a repricing of risk, especially for non-bank financial companies or NBFCs. A widening of the credit spreads on top of the rise in the benchmark 10-year yields will increase the cost of funds and impact their margins. In addition, tightening of liquidity will lower their growth for the next few quarters. We think that there will be near-term pain in earnings for NBFCs and wholesale-oriented banks. Now, the RBI and the government have indicated that adequate liquidity will be provided to NBFCs, even as the RBI has cautioned that the current business model of funding their long-term assets with short-term liabilities is not sustainable. With lower credit growth, the consumer discretionary sector will also get impacted right ahead of the busy festive season. Coming to our view on the equity markets. Amidst the global macro headwinds, all the emerging markets have seen a sell-off. In India, the Nifty 50 index has corrected almost 12% from its peak, the mid-cap index has corrected 25% and the small-cap index has corrected 40%. We expect the markets to have a soft patch for the next 6 months till the elections. The markets will bottom out, however, there is a risk that it will overshoot on the downside. While the corporate earnings may be cut due to the previously mentioned developments, the overall earnings growth still remains supportive. In addition, valuations have also declined to their long-term average and will provide a cushion to overall markets. Hence, we would recommend that investors continue to build their equity exposure over the long term. They will be better off doing SIPs and STPs for the next 6 months rather than doing lump sum investments. It would also be prudent for investors to allocate 20% of their corpus to mid-cap and small-cap funds. Valuations in that space have become attractive even as we remain constructive on overall growth. In terms of sectoral outlook, sectors which benefit positively from rupee depreciation include IT, pharma, metals and mining, and auto ancillaries. We continue to like the consumer discretionary space with sectors such as autos, small appliances, and white goods. For private sector banks, an increase in their market share will be a secular trend over the next decade. We provide a basket of suitable funds for equity investors to choose from. Coming to our view on the debt markets, we would recommend that investors stay put in accrual funds as they provide higher yields and lower volatility in the current environment. Thank you and happy investing.